Thank you. It's a meeting of the Commodity Futures Trading Commission, and I'd like to welcome members of the public, market participants, and members of the media, as well as those taking part on the phone or via webcast. I'd also like to ask for your patience with me this morning, as I've seemed to have caught an awful cold, one flight too many, clearly. Today we meet to consider two important measures. The first is an interim final rule on margin requirements for uncleared swaps for swap dealers and major swap participants in light of Brexit. The second is a final rule regarding the de minimis exception to the swap dealer definition, swaps entered into by insured depository institutions in connections with loans to customers. Other items that had initially been noticed for this open meeting will be forthcoming through seriatim and released over the next couple of days. As always, let me thank the great CFTC staff for their work on today's rules and determinations and what I'm sure will be instructive presentations and discussion. And I thank my fellow commissioners, Quintens, Benham, Stump, and Berkowitz, for their engagement and thoughtfulness on these matters and others that are moving through the Commission. Turning to the first matter, as we well know at the CFTC, trading markets crave certainty. Thus, market regulators have a responsibility to avoid creating market apprehension and doubt whenever possible. At a time of heightened market uncertainty caused by Brexit, this Commission has worked over the past several weeks to bring clarity to participants in global derivative markets by a series of separate actions and statements with its regulatory counterparts in London, Brussels, and Singapore. 4 weeks ago, the Commission and the Bank of England, including the Prudential Regulation Authority and the Financial Conduct Authority, issued a statement regarding derivatives trading and clearing activities between the United Kingdom and the United States after the UK's withdrawal from the European Union. The statement assured market participants of the continuity of derivatives trading and clearing activities between the UK and the US after the UK's withdrawal from the EU. Today, the Commission takes another important step to bring certainty to the global derivative markets. Consistent with actions taken by U.S. prudential regulators, we are providing regulatory certainty regarding the transfer of uncleared legacy swaps to facilitate global swaps market participants' needs in the event that the UK withdraws from the EU without a negotiated withdrawal agreement. Soon the Commission and the Financial Conduct Authority intend to sign two memoranda of understanding related to the UK's withdrawal from the EU. The two signed MOUs will update existing MOUs originally signed in 2016 and 2013 to provide for continued supervisory cooperation with respect to certain firms in the derivatives and the alternate investment fund industry. The signing of these supervisory MOUs with the FCA will ensure continuity and effective cross-border oversight of derivative markets and market participants. These measures show that the UK and the US authorities are committed to taking measures to ensure the UK's withdrawal from the EU, in whatever form it takes, will not create regulatory uncertainty regarding derivative market activity between the UK and the US. These measures will help support financial stability and the sound functioning of financial markets. They also will give confidence to market participants about their ability to trade and manage risk through these markets. I compliment the DSIO staff for putting together this interim final rule and request for comment. And I commend them for their many hours of hard work, the quality of that work, and their thoughtfulness and engagement throughout. And I'm also very grateful to my fellow commissioners for their commitment and engagement on these critical actions. Turning to the second matter, the Commission will consider today the final rule for the de minimis exception for swaps entered into by IDIs, insured depository institutions, in connection with loans to customers. We have received strong public support for providing a narrowly tailored exception that promotes the use of loan-related swaps in a commercially practical and cost-effective manner. I believe the joint statement I issued with SEC Chairman Clayton in December was clear about the authority and intent to address these types of swaps. This final rule will increase efficiencies and reduce the burdens for banks, particularly small and regional banks, to enter into swaps with their end-user loan customers without the added burden of unnecessary regulation and associated compliance costs. These important loan-related swaps allow borrowers to minimize and hedge interest rate, currency, and commodity risks and focus on growing their businesses and, as a result, the economy. Similarly, lenders benefit from these swaps by way of improved creditworthiness of borrowers with an improved ability to repay their loans. The preamble to the proposed rule directs the CFTC Office of Chief Economist to conduct a study after 3 years of implementation. This study will examine future trading data to see how the market has operated under the rule. It will assist the future Commission in considering whether there is a need for limitations on IDI swaps activity, and if so, at what levels. The study is the result of a discussion I had with Commissioner Berkovitz, who suggested adding limits to the notional size of the swaps in connection with the principal balance of the related loans. The final rule before us does not set such limits, but requires the study, and does not preclude the Commission from setting limits in the future if deemed appropriate based upon the results of that study. I believe imposing such limits at this time, however, would be inappropriate without data on which to base such limits and without supportive public comments. As I've said many times before, I believe the CFTC policy is best when it's driven by hard data and not assumptions. But I do take seriously indeed the concern about potential misuse of this rule in ways that are not intended. The preamble makes clear that the Commission expects that the swaps entered into by IDIs are made in connection with and related to the originating loan. For instance, a swap with a borrower entering into it for speculative or investment purposes not related to the loan would not be accepted by the IDI from the de minimis calculation. And IDIs, as depository institutions, remain subject to prudential supervision for all their activities, including swaps activities. Finally, this rule does not remove the core Dodd-Frank Act swaps requirements of clearing, post-trade reporting, and mandatory trade execution, which I fully support. Again, I'm pleased to see this rule finalized. I do not intend to put before the Commission any other de minimis exception during my remaining time on the Commission. Nevertheless, staff continues to study possible alternative metrics for the calculation of the swap dealer de minimis threshold, including possible risk-based approaches. And I expect the results of that work will be reviewed by the Commission under the next chairman and considered then for further action. In conclusion, I want to thank everyone at the tables and those seated behind them for their fine work on these rules and determinations, and I look forward to their presentations and to hearing from my fellow commissioners. I'd now like to go to commissioners for their opening statements, and I'll begin by recognizing Commissioner Quintens for his opening remarks.
Thank you, Mr. Chairman, and thank you for calling this open meeting to consider two very important rules that are of great significance to both the global and the domestic swaps market. The first, as you described, provides the market with much needed regulatory certainty in light of a potential forthcoming Brexit. And the second amends the de minimis exception from swap dealer registration for IDIs to ensure that Main Street banks will be able to continue to serve the needs of their small and medium-sized commercial clients without registering as a swap dealer. Of course, this rule addresses only one of many potential improvements contemplated by the June 2018 proposal that should be ultimately finalized by the Commission. I'm looking forward to hearing the presentations, asking questions, giving fuller comments on each rule at the conclusion of the staff presentations, but ultimately supporting both rules. And I thank the staff very much for their hard work. Thank you.
Thank you. Commissioner Benham.
Thank you, Mr. Chairman. Before I start my prepared remarks, my prepared opening, I do want to thank you and recognize your leadership on the Brexit-related matters. Notwithstanding the obvious rulemaking we're addressing this morning, there's been a number of issues you've brought up you've kept staff and the commission up to date on the changes, which is out of our hand, right? We can only react, but do appreciate your leadership. I think of all U.S. regulators, we're probably best prepared, and that's of course because of you. So thank you for that, and I look forward to asking questions and taking a vote on that. I want to thank all the commission staff who worked to make today's meeting possible, both those who will be presenting at the table today and those who provided the knowledge and analysis supporting their statements. I'll keep this statement brief as I have submitted a statement for publication within the final rule. Albert Einstein said, "A clever person solves a problem, a wise person avoids it." Today, the Commission is voting to finalize a rule that purports to resolve long-standing concerns with the IDI loan-related swap exclusion, referred to in today's final rule as the IDI swap dealing exclusion. The IDI swap dealing exclusion codifies part of the statutory swap dealer definition in Section 1A49A of the Commodity Exchange Act that was jointly adopted with the Securities and Exchange Commission as paragraph 5 to the regulatory swap dealer definition. This is not to be confused with the IDI de minimis provision being finalized today, which establishes an alternative to the exclusion, absent SEC coordination, that in purpose and effect revises the scope of activity that constitutes swap dealing. There is no doubt that the Commission was clever in choosing how to address longstanding concerns that the IDI swap dealing exclusion is unnecessarily restrictive, lacks clarity, and limits the ability of IDIs to serve their loan customers through the unilateral exercise of its authority with respect to the de minimis exception. However, there is also little doubt in my mind that being clever does not make one correct, and I will not be voting in favor of the IDI de minimis provision this morning. The uncertainties embodied in it deprive IDIs and their customers the legal certainty and clarity intended by Congress and may result in increased risk for market participants and perhaps contribute to systemic risk. The Commission would have been wise to avoid creating this rambling IDI exemption that will now sit awkwardly beside the IDI swap dealing exclusion in the Commission regulations. These regulations are a marker of our inability to engage and collaborate with our fellow regulators towards a more practical and legally sound solution. As an independent agency, the Commission should use its expertise to act within its authority and not abuse ill-defined powers to create loopholes. Our agencies are better than that, and more importantly, our stakeholders deserve it. There's been a concerted effort these last few weeks to window dress. However, any suggestion that this relief is surgically targeted to small and mid-sized banks and their end-user customers is unfounded. The IDI de minimis provision refrains from imposing any limitation on size or structure of eligible IDIs or their customers, nor does it cap or require affirmative verification of the aggregate gross notional amount of swaps entered into by an IDI for which it will rely on the IDI de minimis provision. I do not mean to suggest at all that size should be deterministic of whether an IDI should be able to avail itself of relief related to swaps activities in connection with loan origination. Indeed, Congress did not set such limitations on the exclusionary language in Commodity Exchange Act Section 1A49A. However, taken in the context of the unrestricted nature of the rule before the Commission today, as it relates to the relationship between swaps activity and loan origination, and absent any caps, I'm extremely concerned about the potential systemic risk implication to our markets. Small, mid-size, and large IDIs should not be considered swap dealers or required to register as swap dealers with regard to swaps activities related to loan origination with customers, because Congress simply has determined that such activities, subject to the joint interpretation of the CFTC and the SEC, are not swap dealing activities warranting oversight by the commissions. Not because such activities are swap dealing activities which the Commission unilaterally has determined to overlook. I believe that IDIs deserve the fullest application of the exclusion provided by Congress in 1A49A of the Commodity Exchange Act. An exemption or exception leaves IDIs within the crosshairs of future Commission action should political headwinds or shifting policy dispose it to again alter the rules or its interpretation of the Act. I stand by now my several prior statements and continue to believe that the Commission should have worked with the SEC to jointly amend the IDI swap dealing exclusion to more accurately address swap activities inherent to credit risk management encompassed by loan origination in the commercial lending space. Thank you.
Commissioner Stump.
Thank you, Mr. Chairman, and thanks to the staff who worked very diligently to put all of these matters before us. I've just returned from a trip to Europe. I was in Europe last week, and I visited many of our regulatory counterparts across many jurisdictions and many market participants and infrastructure providers who operate truly global businesses. The trip reinforced my belief that every jurisdiction, including the U.S., needs to recommit to the global coordination envisioned at Pittsburgh in 2009, when global leaders committed to work together to improve the system. The alternative of duplicative supervision creates a new web of regulatory vulnerabilities and serves to complicate, not improve, the intended benefit of our recent reforms. I am therefore very pleased that several of the items we had planned to address through today's open meeting were able to be finalized through the Commission's seriatim process, including the comparability determinations for Japan and Australia's uncleared margin requirements. I believe this reflects the CFTC's commitment to a practical, outcomes-based approach to cross-border regulation of our markets. Furthermore, the Commission continues to demonstrate its commitment to facilitating registrants' preparation for Brexit and equipping the CFTC with the tools it needs to cooperate with and obtain information from the UK after Brexit. These are important steps along the appropriate path forward for the regulation of our global markets. Thank you, Mr. Chairman.
Thank you, Commissioner Stump. Commissioner Berkowitz.
Thank you, Mr. Chairman. Good morning. I'd like to begin by thanking the Commission staff. The CFTC has been particularly busy lately on issues of global importance. The staff's hard work and dedication to our mission allows us, despite our size, to be one of the world's preeminent financial regulatory agencies. In particular, I appreciate your work on the issues we'll be discussing today, your consideration and incorporation of many of my office's comments, and the time you've spent with my staff in preparing for this meeting. When the chairman announced this meeting just over a week ago, we had 7 items on the agenda. Fortunately, we were able to approve 5 of these items ahead of today's meeting, including amendments to Commission Regulation 1.52 concerning requirements for self-regulatory organizations, Regulation 23-700 concerning requirements for segregated margin for swaps, margin comparability determinations for Australia and Japan, and updates to memorandums of understanding with the UK's Financial Conduct Authority in preparation for Brexit. So I'm very pleased we won't be here all day with these matters. I thank the chairman for your leadership on these matters and my fellow commissioners and their staffs for their hard work, and my staff as well for their very hard work. In addition, in the past couple of weeks, the Commission has also exempted certain derivatives trading venues in Singapore from registration as swap execution facilities because they meet our comparability standards, has been taking steps with the European Commission to ensure the continuity of derivatives trading and clearing after the UK's withdrawal from the EU, and today we will be voting to maintain the legacy status of certain uncleared swaps if those swaps need to be legally transferred due to a no-deal Brexit. These recent actions show that the CFTC's cross-border regulatory approach that has now been in place for over 6 years and implemented by several successive commissions provides an appropriately flexible framework for addressing the various cross-border issues that the Commission faces in international derivative markets while simultaneously minimizing the financial risks that could come back to the U.S. Finally, the other issue being voted on today is an amendment to the de minimis exception to the swap dealer definition, which excludes from counting towards the de minimis threshold certain swaps entered into by Insured Depository Institutions, or IDIs. I will now just briefly say that I plan to vote against this amendment for both substantive and procedural reasons. In my view, this amendment drives a truck through the de minimis exception to the swap dealer registration rule by permitting an unlimited quantity of swap dealing by an IDI in connection with loans, and any expansion of the IDI exclusion can be adopted only through joint rulemaking with the SEC. I will address these concerns in greater detail when we consider that rule shortly. Thank you.
Thank you, Commissioner Berkovitz. I'd just like to briefly review today's procedure. For each of the 2 items on today's agenda, the staff will make presentations to the Commission. After each presentation, I will then ask for a motion to adopt the rule or item for consideration. I will then open the floor to questions from each of the commissioners, followed by additional statements from each of the commissioners, if any. Following the close of the discussion on each matter, the Commission expects to vote on the staff recommendation as presented. All final votes conducted in this public meeting shall be recorded votes. The results of votes approving the issuance of rulemaking documents will be included with those documents in the Federal Register. At this point, I'd like to ask for a motion, a unanimous consent motion to allow staff to make any technical corrections to the documents voted on today prior to sending them to the Federal Register.
So moved.
Second.
All in favor? Any
Aye.
opposed? Thank you. Without objection, so ordered. At this time, I would like to welcome the following staff for their presentations on the interim final rule proposal on margin requirements for uncleared swaps for swap dealers and major swap participants in light of Brexit. Mr. Culkin, would you introduce your team, please?
Good morning, Mr. Chairman, Commissioners. Happy to introduce Frank Fusanich, Chief Counsel from DSIO, Jake Chaikin, Special Counsel, DSIO. Jake will be leading the presentation this morning. Thank you.
Please proceed.
Today, we are pleased to present an interim final rule to amend the Commission's margin requirements for uncleared swaps, the CFTC margin rule. In an event commonly referred to as Brexit, the United Kingdom may withdraw from the European Union as soon as April 12th. Currently, there is not a negotiated agreement for the UK to leave the EU, and a no-deal Brexit will occur if the UK leaves the EU without such an agreement. One implication of a no-deal Brexit that is relevant to the swaps market is that market participants in the UK, including swap dealers subject to the CFTC margin rule, would not be able to rely on the EU's passporting regime that currently allows persons in the UK to enter into swaps with persons in the EU. While it is not anticipated that existing swap contracts would be directly affected, the loss of passporting may make it impossible to continue servicing existing customers for the various life cycle events that occur during the life of the many swap transactions. As a result, either party to swaps involving UK and EU counterparties may wish to transfer their side of the swap to another party to avoid the issue raised by a no-deal Brexit. For example, the UK party may wish to transfer the swap to an affiliate in the EU that could rely on passporting. In addition, other market participants, wherever they are located, may choose to engage in other reorganizations or consolidations of their swaps business in response to a no-deal Brexit. To accomplish this, the swap dealers may be involved in transfers of uncleared swaps that are not currently subject to the CFTC margin rule or similar rules from the prudential regulators because they were entered into before the relevant compliance dates for those rules. We refer to these as legacy swaps. However, these swaps would currently lose their legacy status and become subject to the CFTC margin rule if they were amended to effect a transfer. The interim final rule amends Commission Regulation 23.161 such that a legacy swap may be transferred to a margin affiliate of the transferor or its branch following a no-deal Brexit without losing its legacy status. Any such transfer must be in response to a no-deal Brexit, and any amendment to a swap that is not necessary to accomplish this transfer would cause the legacy swap to be ineligible for the relief. In any event, to be eligible for relief, parties may not modify certain terms of the swap. Financial terms including an interest rate, the maturity date, or the notional amount of the swap. And the amendments generally must take effect during the year following a no-deal Brexit. Absent a no-deal Brexit, either because a withdrawal agreement is reached or because a Brexit does not occur, the interim final rule does not provide any relief. The interim final rule is similar to an interim final rule that the prudential regulators issued recently. An important difference, however, is the prudential regulators rule provides only for transfers from the UK to an affiliate in the EU or the US. Whereas the CFTC rule would provide for transfers between any margin affiliate wherever located. Staff recommends that the Commission issue the interim final rule rather than a rule proposal, given the short time until the Brexit deadline and potential for market disruption. Thank you for your attention. Be happy to discuss any questions you have.
Does that conclude your presentation?
Yes.
Thank you very much. To begin our discussion and consideration of this rulemaking, I'd like to now entertain a motion to adopt the Division of Swap and Intermediary Oversight's interim final rule.
So moved.
Second.
Thank you. Motion is now before us. Commissioners may question the presenters. I have no questions. I'll invite Mr. Quintens to, Commissioner Quintens.
Thank you, Mr. Chairman. Again, thank you to the staff for your hard work on this. I just had one question as a point of clarification. Is it accurate that the interim final rule provides relief from margin requirements for an uncleared legacy swap transferred to a counterparty outside the UK only if a no-deal Brexit occurs? In other words, if such a transfer were to occur in the absence of a no-deal Brexit, then would the counterparties to that legacy swap be required to margin the swap in accordance with CFTC regulations?
Yes, the interim final rule only provides relief in a no-deal Brexit scenario. So if there is not a no-deal Brexit, a transfer of swap to a new counterparty would constitute a new swap, and that would be in scope for the margin requirements of the CFTC margin rule.
Okay, thank you very much. I have no further questions, Mr. Chairman.
Commissioner Benham?
Thank you, Mr. Chairman, and thank you, staff, for your work on this. One quick question. The prudential regulators took action similar to this a few weeks ago, I believe. Is that correct?
Yes.
And I think there's a slight difference between the proposal before us today and theirs, and if I'm correct, or correct me if I'm wrong, but the interim rule before us today would permit transfers to any margin affiliate, no matter where they're located, so long as it meets certain conditions. In contrast, the prudentials only permit transfers from the UK to an affiliate in the US or the EU. Is that correct?
Yes, that is correct.
And then can you just briefly describe the distinction and whether or not, why we're being a little bit more flexible than the prudentials?
Sure. So as you note, the prudential regulators rule provides only for transfers from the UK to an affiliate in the EU or the US, whereas the CFTC rule more broadly provides for transfers between any margin affiliate or branch wherever located. I would note the prudentials ask questions about expanding the relief, and they may do so. So it's not clear, similar to the way that we ask questions, if the rules will be that different when finally becoming applicable.
That's fine. Yeah, I appreciate that.
Okay, thank you.
Just a brief statement, Mr. Chairman. Absent today's action by the Commission, legacy uncleared swaps transferred to an affiliate due to a no-deal Brexit could be treated as new swaps and therefore fully subject to the CFTC margin rule. Subject to conditions, the interim final rule will maintain the status quo for legacy uncleared swaps with respect to our margin rules for such swaps. I want to thank staff again for their hard work on this rule, which provides certainty to market participants regarding the impacts of a no-deal Brexit on their legacy swaps. So thanks to you, and again, thank you, Mr. Chairman, for your leadership on this.
Thank you, Commissioner Benham. Commissioner Stump?
I have no questions. Thank you all for your efforts. I'm very supportive of the interim final rule.
Commissioner Berkowitz?
Thank you, Mr. Chairman, and thank you, Matt, Frank, and Jake, for your work on this IFR and your responsiveness to the comments and suggestions that I believe have helped improve the IFR that we're voting on today. I just have two questions, and this may be very similar to Commissioner Quintens's question. The IFR, I understand, only applies to the legacy swaps that are transferred solely in connection with a no-deal Brexit.
That is correct.
And the IFR is not intended to provide parties with an opportunity to renegotiate the economic terms of this legacy swaps. Is that correct?
That is also correct.
Thank you very much.
Thank you.
Commissioner Berkowitz, thank you. Do any commissioners wish to make a statement on this before we go to a vote? Please proceed.
Just a brief statement. I'm going to be voting in favor of the IFR for this relief. Although we do not yet know the date of the UK's withdrawal from the EU, the form it will take, or even whether it will take place, market participants worldwide are preparing for Brexit. The Commission is committed to working with our domestic and international partners to facilitate regulatory continuity and provide stability to the derivatives markets if and when Brexit occurs. Today's action is a continuation of that effort. I commend the chairman and the commission staff for their efforts to address these and other Brexit-related cross-border issues. I note in particular that these actions are all taken pursuant to and are consistent with the existing regulations and guidance in place at the CFTC governing cross-border activities. The IFR will maintain the legacy status of swaps that were executed prior to the relevant compliance dates for the CFTC swap margin rule if those swaps are legally transferred solely as a result of a no-deal Brexit. The transfer of these swaps to affiliates outside the UK would be needed so the swaps can continue to be properly serviced under EU law. A no-deal Brexit would be the result of political events beyond the control or anticipation of the parties at the time they first entered into the legacy swaps in question. Under these circumstances, if the CFTC's margin rules were applied, the transfer of these legacy swaps could entail significant expenses which could impede such transfers. The failure to efficiently and effectively accomplish these transfers could introduce new systemic risks globally. The IFR release makes clear that legacy swap transfers get relief solely if they are undertaken in connection with a no-deal Brexit. The release and the questions and answers make it clear that this IFR does not create an opportunity for the parties to renegotiate the economic terms of legacy swaps. Swaps that are amended or renegotiated, other than to the extent permitted by the IFR, would still be subject to the CFTC's margin rules. These limitations are important as they prevent abuse of the flexibility provided by the IFR. And again, I thank the staff and the chairman and my fellow commissioners.
Thank you, Commissioner Berkowitz, and thank you for your compliments. I do want to go right back to you and to my fellow commissioners. On matters of great importance on the international spectrum, this commission has spoken with one voice over the last several months in very important matters, giving market certainty to market participants and letting overseas counterparts know that when they deal with the CFTC, they deal with an agency that can move properly, directly, and with one voice. I think it's been really a mark of great compliment to our agency, the work we've done with regard to Brexit, with regard to EMIR 2.2, with regard to recognition of overseas regulators. So I thank all of you for your support on these matters. I have no more comment to make on this matter. I think it is time we'll go to a vote. Are commissioners prepared to vote? Okay. Mr. Kirkpatrick, would you please call the roll call?
The motion now before the Commission is on the adoption of the interim final rule on margin requirements for uncleared swaps for swap dealers and major swap participants in light of Brexit. Commissioner Berkowitz.
Aye.
Commissioner Berkowitz votes aye. Commissioner Stump.
Aye.
Commissioner Stump votes aye. Commissioner Benham.
Aye.
Commissioner Benham votes aye. Commissioner Quintens.
Aye.
Commissioner Quintens votes aye. Chairman Giancarlo.
Aye.
Chairman Giancarlo votes aye. Mr. Chairman, on this matter, the ayes have 5, the noes have 0.
Thank you. At this time, I'd like to welcome the following staff for their presentation. Well, let me first thank this staff. Thank you very much. Well done. And now we'll welcome to the table Amanda O'Lear, Matt Culkin again, Rajal Patel, and Jeffrey Hasterrock. And to begin our discussion and consideration of this rulemaking, I'll now entertain a motion to adopt the Division of Swap and Intermediary Oversight's final rule.
So moved.
Second.
Thank you. The motion is before us. I'd just like to review procedure again. We'll do questions. What I've asked commissioners to do is hold their statements. We'll complete the questions. Once there's no further questions, then we'll go to statements, if that's all right. Fine. So, Mr. Culkin, would you have your team give their presentation?
Sure. Thank you again, Mr. Chairman. Good morning, commissioners. The Division of Swap Dealer and Intermediary Oversight recommends amending the swap dealer de minimis exception by adding a new factor to remove from counting towards the $8 billion threshold swaps entered into by insured depository institutions, or IDIs, in connection with originating loans to customers. This new factor was proposed by the Commission in June 2018 and supported by the public comments received. This This new factor will give small and mid-sized U.S. banks much-needed certainty and clarity related to our swap dealer registration requirements. As a result, these IDI's commercial end-user loan customers will be able to more easily manage loan-related risk through their existing banking relationships. Before I turn it over to the team to present on the specifics, I want to first recognize Amanda O'Lear, Acting Deputy Director, Rajal Patel, Associate Director, and Jeff Hastrock. I'd also like to recognize former DSIO Deputy Director Eric Remler, as well as our Office of the General Counsel colleagues Dan Davis, Carlene Kim, Mark Pfeiffer, and Paul Schlichting, plus Office of the Chief Economist colleagues Bruce Tuckman, Scott Mixon, and Steve Kane for their significant contributions to today's release. I'd like to thank each of your offices and your staffs for providing constructive feedback and suggestions for our recommendations. Amanda, Rajal, and Jeff will now lead the discussion about the adopting release, but I want to remind market participants that the adoption of this new factor does not remove compliance obligations related to certain of the Commission's swap market rules, including our rules related to trade execution, mandatory clearing, and swap data reporting. And IDIs, of course, remain subject to supervision by their primary banking regulator. I'll now have Amanda speak a little bit about the specifics of the rule before you.
Thank you, Matt. Mr. Chairman and Commissioners, today's adopting release amends the de minimis exception within the swap dealer definition in the Commission's regulations. The adopting release establishes an additional factor in the de minimis threshold determination for swaps entered into by IDIs in connection with loans to customers. This amendment originates with the definition of swap dealer in Section 1A49 of the Commodity Exchange Act, which explains what constitutes swap dealing activity and also provides that the Commission shall promulgate regulations to establish factors to exempt from designation as a swap dealer an entity engaged in a de minimis quantity of swap dealing. CEA Section 1A49 further provides that in no event shall an IDI be considered to be a swap dealer to the extent it offers to enter into a swap with a customer in connection with originating a loan with that customer. A number of policy considerations inform today's amendment. As the Commission has stated, the primary goals of regulating swap dealers include reducing systemic risk, increasing counterparty protections, and increasing market efficiency, orderliness, and transparency. However, consistent with congressional intent, an appropriately calibrated de minimis exception has the potential to advance other interests, including increasing efficiency, allowing limited swap dealing in connection with other client services, encouraging new participants to enter the market, and focusing regulatory resources. Before handing this over to Jeff and Rajal, I also want to highlight that we consulted with the SEC and the prudential regulators in the preparation of this release. In particular, we shared a number of drafts of this adopting release and responded to comments received. I will now turn to Jeff to discuss the data used to inform this rule amendment.
Thank you, Amanda. Mr. Chairman and Commissioners, good morning. This rule amendment relied on a detailed analysis of 2017 transaction data reported to swap data repositories per Part 45 of Commission regulations and demonstrates empirically driven policymaking. Consistent with the June 2018 NPRM and the November 2018 adopting release, we designed our analysis to examine the swaps activity of likely swap dealers. The analysis included a calculation of the aggregate gross notional amount, or AGNA for short, of swaps activity across interest rate, credit default, foreign exchange, and equity swaps. We focused the analysis for this adopting release on the swaps activity of IDIs that may be most likely to be affected by today's amendments, especially those IDIs with AGNAs near now the finalized $8 billion de minimis threshold. We specifically evaluated IDIs with AGNAs of swap activity within a variety of activity ranges, but especially within the range of $1 to $50 billion. We focused on the range of $1 to $50 billion because our analysis showed that IDIs with larger AGNAs outside of this range appear to have a significant amount of activity unrelated to loan origination swaps. We believe that today's amendments are most likely to allow non-registered, small and mid-size IDIs with lower AGNAs to expand their loan-related swap dealing activities with their lending clients without incurring the costs of swap dealer registration. For transactions between two entities not currently registered as swap dealers, but with at least one of the entities being an IDI, the total AGNA was approximately $6.5 billion to $16.5 billion per range, depending on the range between $1 and $50 billion analyzed. So, in percentage terms, in relation to the market-wide total of $221 trillion, the $6.5 to $16.5 billion is equivalent to 0.003 to 0.007%. So in other words, less than a basis point of the overall market. These totals are indicative of a de minimis quantity of swaps activity. I will now turn to Rajal to discuss the rationale for and the structure of this rule amendment.
Thank you, Jeff. Mr. Chairman and Commissioners, I'll start by emphasizing that the policy objectives underlying the de minimis exception, which Amanda discussed earlier, are designed to encourage participation and competition by allowing persons to engage in a de minimis amount of dealing without incurring the costs of registration and associated swap dealer regulations. As additional background, in May 2012, the Commission's adopted, pursuant to the CEA, an IDI loan-related swap exclusion in paragraph 5 of the swap dealer definition, which I'll refer to as the IDI swap dealing exclusion. However, we understand that certain IDIs are restricting entering into loan-related swaps because of the potential that these swaps would not be eligible for the IDI swap dealing exclusion and therefore would be counted towards an IDI's de minimis threshold, potentially requiring the IDI to register as a swap dealer and incur registration-related costs. Market participants indicated that conditions of this exclusion are not clear in all circumstances or are too restrictive for the intended purpose. The restrictions on loan-related swaps by IDIs may result in reduced availability of swaps for the loan customers of these IDIs, particularly small and mid-sized banks, potentially hampering the ability of end-user borrowers to enter into hedges in connection with their loans. We believe that the IDI de minimis provision advances the policy objectives of the de minimis exception by allowing some IDIs to provide additional hedging swaps to customers in connection with originating loans. The amendment should also facilitate an appropriate level of swap dealing in connection with other client services and may encourage more IDIs to participate in the swap market. Greater availability of loan-related swaps may also improve the ability of customers to hedge their loan-related exposure. I'll now return our presentation back to Matt.
Mr. Chairman, that concludes the staff presentation. We'd be happy to answer your questions.
Thank you, Mr. Culkin. Well presented. We'll now go to questions, and I will open the floor up, and beginning with Mr. Quintens for questions.
Thank you, Mr. Chairman. Amanda, could you reread the language in the statute that discusses the de minimis exception?
Thank you. The Commission shall exempt from designation as a swap dealer an entity that engages in a de minimis quantity of swap dealing in connection with transactions with or on behalf of its customers. The Commission shall promulgate regulations to establish factors with respect to the making of this determination to exempt.
Thank you. So it appears to me, in fact, I don't think it appears, I think it's quite obvious and self-evident that Congress constructed that language to apply to an entity, not to the total universe of swaps that fell outside of a registration regime. Said differently, the language that discusses the de minimis exception talks about the quantity of swaps that an entity can deal as being a de minimis quantity of swaps in relation to the market, as opposed to the amount of swaps being de minimis that would exist outside of the registered swap dealer marketplace. Is that correct?
So, Commissioner, if I understand your question, you're correct that the recommendation before you today is a factor related to the calculation of whether or not an entity exceeds the de minimis threshold. We are talking about a factor in that calculation, which is set forth by 1A49D, which Amanda just read, that is separate and apart from 1A49A, which talks about what is a swap dealer and what is swap dealing. This is solely a factor related to what counts towards the threshold.
Right. A threshold that applies to an entity, not
Yes,
not a
that's-
threshold that tells us what size of the market we have to regulate.
That's correct.
Okay. Mr. Culkin, you know that I have severe problems with notional value being used as a metric or a threshold generally, and in this circumstance specifically. But if we're going to compare apples to apples, could you remind me, and I think, Jeff, you had mentioned it, could you remind me of the total size of the swaps market that we're looking at?
$221 trillion, sir,
Trillion with a T.
with a T.
And our de minimis threshold is 8 billion with a B.
Yes, with a B. 8 with a B.
So even if we were to adjust the size of the notional value of the swaps market by the construct that our Office of the Chief Economist has used and developed called entity netted notionals, where you net a long and a short exposure only by entity and not generally, and you adjust it for duration. The size of the market that they're looking at, which only consists of rates, FX, and sovereign and corporate CDS, narrows down to 34 trillion with a T. By my calculations, an $8 billion threshold is only 0.0002 of that number. That's 2/10,000ths. Does that sound like a de minimis amount to you?
Yes, Commissioner.
Does 5/10,000ths sound like a de minimis amount to you?
Yes, Commissioner.
I could go forward asking more questions about what really a de minimis amount is, but I think right now we're in safe territory and we have a lot of room to still remain in safe territory. Getting back to the scope of the number of registered entities that we have. When prior CFTC Chairman Gary Gensler testified in his nomination hearing back in 2009, he stated that he thought 15 to 20 large financial institutions would ultimately qualify for any new swaps regulatory regime. Matt, do you know off the top of your head how many registered swap dealers we currently have?
We have 103 registered swap dealers.
103,
Yes, Commissioner.
not 15,
No, Commissioner.
103.
Yes, Commissioner.
That's a 500% margin of error. Following the adoption of this amendment, how likely do you think that it is that any of those 103 will deregister?
Thank you for your question, Commissioner. We certainly focused our analysis on the lower end of activity because we believe that that range and that cohort is most likely to be affected by this. But we certainly did not exclusively examine that cohort. We looked at larger cohorts. We don't believe that the largest money center banks are likely to deregister because of this amendment. We feel that it is most applicable to the smaller IDIs that are well positioned to take advantage of this and use it in conjunction with their lending clients.
Okay, so in terms of likelihood, would it be more likely that 50 swap dealers deregister or a handful?
So, Commissioner, based on the analysis we performed in this $1 to $50 billion AGNA cohort, as Jeff calls it, there are 2 registered IDI swap dealers. So we can't speculate as to who might or might not deregister, but we're talking about a few at most.
Out of 103.
Yes, Commissioner.
So that's still about a 500% margin of error. Matt, I wanted to talk to you quickly about end users. Have you heard any anecdotes of small businesses who are customers of smaller and middle regional banks that have chosen not to hedge their risk because their primary banking relationship fears getting caught up in the swap dealer registration regime?
So, Commissioner, what we learned in the comment process is that there are end user borrower customers of insured depository institutions where the IDI is monitoring its swap dealing activity to make sure it stays below the $8 billion, so as to avoid registration and the swap dealer regulations. What we understand to be the case is that some customers, if they're unable to get a swap to hedge interest rate risk, commodity risk, currency risk from their lending institution, they either have to find a registered swap dealer to provide that risk, and it would be separate from the lending operation. You'd now have two commercial relationships. Or what is often the case, as we understand it, is that the borrower simply goes unhedged on their risk.
Is the second actually occurring?
We believe it is occurring, yes.
So today's amendments would help assist those borrowers to not go unhedged and keep their primary relationship.
Yes, that's our understanding. Especially most of the swaps activity that we're talking about today is interest rate swap activity tied to a borrower having a floating rate loan over 3 to 5 years and wanting to lock in a floating rate to ensure, from a cash flow perspective, that they can meet their obligations to their to their lender.
Okay, thank you. I just wanted to quickly finish with some discussion of how you coordinated with the SEC. You did coordinate with the SEC.
Yes, Commissioner, and the Federal Reserve, FDIC, and OCC.
Thank you. Does the final rule affect the amount of security-based swaps that would be included by an IDI in determining whether that IDI has to register?
No, Commissioner. The recommendations before you only deal with swap dealing activity.
Okay. Thank you very much. I have no more questions, Mr. Chairman.
Commissioner Benham.
Thanks, Mr. Chairman, and thanks to the entire team for your presentation and your work. Just take a step back to 2012 when the Commission originally drafted a rule for swap dealer definition, and we did in fact do it jointly with the SEC. And that determination was made based off of Section 712 of Dodd-Frank, which in my mind is fairly clear, so I won't repeat it. But now that we're making a determination that IDI can be a de minimis exclusion factor, can you help me walk through the sort of evolution of thought from the 2012 decision, which I think was fairly unanimous within the Commission, and how we're now constructing a legal theory that's based on a single word in the de minimis exception language?
Sure, Commissioner, thank you. So I won't repeat 1A49D because Amanda read it a moment ago, but I would like to go back to the joint adopting release that you referenced with the SEC. And at that time, the Commission's plural said, quote, a joint, I'll back up. In our adopting release today, we write, the Commission writes, that the Commission continues to believe that, as stated in the NPRM, comma, quote, and this is now citing the joint SEC-CFTC definitional release, a joint rulemaking with the SEC is not required with respect to de minimis exception-related factors, end quote. The adopting release today then says, as stated in the swap dealer definition adopting release that was jointly adopted with the SEC, and again, this is a quote, CEA section 1A49D with a parenthetical reference to the corresponding provision in the Exchange Act, particularly states that the Commission, in quotes, meaning the CFTC, because it's in the singular, may exempt de minimis dealers and promulgate related regulations. We do not interpret the joint rulemaking provisions of Section 712D of the Dodd-Frank Act to require joint rulemaking here, because such an interpretation would read the term Commission out of 1A49D and the corresponding Exchange Act section, which themselves were added by the Dodd-Frank Act. And now going back to today's adopting release, accordingly, the Commission believes that although the definition of swap dealer requires joint action, the statute allows for the CFTC and the SEC to individually determine the threshold and factors that exempt de minimis swap dealers and security-based swap dealers pursuant to Section 1A49D and Section 3A71D of the Securities Exchange Act of 1934, respectively.
So, I mean, that argument it presumes, though, that the de minimis exception goes beyond quantity, that the Commission should consider characteristics of swap dealing activities when it's interpreting 1A49D, as opposed to just purely, in my mind, what de minimis in any context means, which is value, size, quantity.
So if I understand your question, the joint adopting release also makes clear that the Commission should set forth an objective, qualitative standard that's self-executing. And so something that can be applied efficiently and with predictability. It does not require a hard numerical quantity. And even the joint rulemaking from 2012 that you just referenced indicates in that release that alternative approaches might be appropriate. And so this is an example of an alternative approach.
So let's hypothetically, I am going to hypothetically for a moment say I agree with you in terms of your interpretation of subpart D. Why, and we've had a lot of conversations about congressional intent, why do you think Congress would have created a specific carve-out, for lack of a better word, in 1A49A for IDIs, even though it then would have intended for IDIs to be a factor within 1A49D? To me, that seems a little bit duplicitous. You're going to create an IDI exemption in one place. Why would you then want it to be a factor in a separate place?
So, Commissioner, the factor provision in 1A49D recognizes that there will be instances where a de minimis quantity of dealing should be permitted without swap dealer regulation or registration. And these are the policy goals that Amanda and Rajal just talked about in terms of ancillary dealing in connection with another business, new entrants into the market. And so when we look at the factor requirement for a de minimis exception, and we run numbers and find ourselves looking at activity that measures 0.003 to 0.007% of the marketplace, we find that to be wholly within a de minimis quantity as set forth by the statute. And so that's how we arrive at the recommendations for today.
So next step in that sort of, I think, argument is when I look at 149A, and I appreciate the points about the size of the market, the very small size of the market, and the economic analysis. That all makes very clear sense to me. But I do believe it needs to be bucketed in the de minimis quantity silo, for lack of a better word. The issue I have is when I look at 149A, Congress pretty clearly says that swaps activity related to loan origination from an IDI is not swap dealing. So, and quoting it, however, in no event shall an IDI be considered a swap dealer. So by creating a factor within the exception for an IDI, in my mind, you're essentially forcing IDI-related swaps activity into swap dealing when, in fact, Congress intended for IDI-related swaps activity not to be considered. So then let's consider the compliance officer at this regional bank who has to now, I think, create two spreadsheets, one for its pure IDI loan associated swaps activity, which again, Congress intended it not to be swap dealing activity. And then it's going to have to, and because the rule, and I agree with this, that the original rule from 2012 is too restrictive, that there are certainly things that we need to change as a commission to reflect on what was made in an unintentional way or was just made drafted poorly. But now they're going to have two spreadsheets, and one is going to be you're excluded from swap dealer definition because it's an IDI related loan. But for the loans that don't fit nicely into that 2012 rule, we're going to go into the second spreadsheet and have a de minimis exemption. And it's going to be considered swap dealing, but we're just going to exempt it because it is de minimis.
Commissioner, so first I'd point out that these IDIs are highly regulated entities. We didn't receive anything in the public comments from any of the IDIs suggesting that they found this confusing or that they were worried about the regulatory burden for calculating, as you suggest, potentially two separate tracks. In fact, we're pretty certain that they are currently monitoring their IDI dealing activity. We expect them to continue to do that. But the comments that we received didn't touch on any potential confusion or overbearing burden. In fact, we received the opposite. We received comments that indicated that they would find this much more easily implementable and easier to comply with, and then in fact have the added benefit of providing increased hedging to their current customer base.
I appreciate that response, but that seems like an obvious response from a constituent in this certain circumstance. This won't be a question, but I do think that it should be emphasized. It clearly states in the statute that an IDI related swaps activity is not swap dealing, and by creating this proposal is essentially putting IDI related swaps activity into a de minimis exception and de facto making it swap dealing, which is, in my mind, contradictory to what Congress intended. You mentioned the prudential regulators, and I appreciate that we have obviously market participants who have multiple regulators. Can you talk a little bit about how the oversight of our sister regulators will sort of effectuate itself, and what kind of agreements or what kind of information do we know about what the prudentials will do with respect to these IDIs and these swaps activities?
Sure. So I'll start with the commission's component, and nothing in today's recommendation impacts Part 43 or Part 45, the trade reporting obligations that market participants have to trade repositories. But as you noted, IDIs remain subject to their primary bank regulator's supervision, which means they have to conduct their business in a manner consistent with safety and soundness principles. They'll continue to have examiners who evaluate their risk management program, look at their operations, assess their capital adequacy, look at collateralization, and then of course the banks will report their swaps and call reports and other financial reports that allow both bank regulators to ensure that the swaps activity and the loan activity are correlated, and then we'll still have the benefit of our SDR reporting to look at positions.
So, notwithstanding the SDR reporting, which you just mentioned, how are we going to sort of monitor compliance with this provision? Both the de minimis provision and then I guess the swap dealing exclusion as well.
So it has always been the case that the burden for calculating registration thresholds and registering as a swap dealer is a burden that rests with the registrant, and that will remain true after today's rule.
There was a 2016 final staff report on the dealer de minimis exception that, and this is going back a little bit to my earlier line of questioning, but I don't want to oversee it here. The final report argued that the scope of the IDI exclusion to be expanded, it should be expanded because of needed flexibility. As late as early 2018, which I think is when I first started to engage with some of your staff, the commission noted that the constraints of the statutory language limit it to addressing IDI concerns regarding the exclusion through joint action with the SEC. So, and tell me if I'm wrong, but this sort of evolution of thought from as late as March 2018 to the NPRM in June of 2018 changed. What may have changed, and then if you, and Amanda, I know you talked about this, and Matt, you may have too, but a little bit more on the discussions with the SEC and the PRUs about this, and what kind of conversations we're having.
So I'll answer the second part first. So since the June 2018 NPRM was published, excuse me, we've had a series of conversations with the SEC, the Fed, FDIC, and OCC. We've shared a number of drafts going back to the November adopting release, setting the de minimis threshold at $8 billion through today. We've shared a number of drafts of our rulemakings with the SEC. We've received feedback from the SEC. We've held calls with the SEC, and I don't mean just the SEC, but the FDIC, the Fed, and the OCC as well. We've spoken with staff at each of those agencies. We've received feedback on our proposals as they've evolved, and we've had a very good working relationship with each of the agencies.
And last question, the chairman mentioned the study that's being conducted through the Office of the Chief Economist, and I think thinking about that study, and then also the language in the proposal today that does not sort of cap swap dealing activity. What was the logic in having the study punted 3 years as opposed to, creating some level of caps for activity reasonable, right? Like, again, going to my earlier point, appreciating the fact that the 2012 rulemaking probably is not in the right spot or where it needs to be in order to incentivize our banking community to lend to end users. But why not set a cap at a reasonable level, conduct a study, and then reconsider based on data we receive over time?
So, Commissioner, I think the answer is we don't know what a reasonable level should be or could be. It's not something we contemplated in the NPRM. It's not something we've studied. It's not something we've received comment on. But we hope, working with our colleagues in the Chief Economist's office, that once we have a better sense of what would be reasonable, if in fact a cap is appropriate, we can then come back with those recommendations.
I would just say, it might be hard, but when I read the language, and we did not discuss about this, of the statute, specifically 1A49A, in no event shall an IDI be considered to be a swap dealer to the extent it offers to enter into a swap with a customer in connection with originating a loan with that customer. We did not talk about the permissible language, but it's pretty clear to me, and I know we deal with this issue in many contexts within this agency. Things are not apples to apples, and we have to be principles-based when it's appropriate. We have historically been a principles-based regulator, but when Congress expressly states in connection with originating a loan with that customer, I don't think it should be very hard to determine a cap on the amount of swaps activity an IDI can enter into. And then that, in my mind, is still a little bit flexible from the express language of the statute, and then we can go afterwards, after a thoughtful study, and say, you know what, maybe we need to amend it at some point. But anyhow, thanks again to all of you for your time, your patience, your hard work. I appreciate it, of course, and thank you, Mr. Chairman.
Thank you. Commissioner Stubb, questions?
I don't have any questions with regard to the legal interpretation of the statute, but just a point of clarification that you can either dispute or validate. In this context, when we're talking about borrowers with insured depository institutions, we are primarily talking about swaps of a nature of interest rate swaps, commodity swaps, and currency swaps. None of those are security-based swaps. Is that accurate?
That's correct, Commissioner.
So, therefore, none of them are within the jurisdiction of the SEC, correct?
That's correct.
Thank you.
Thank you. Commissioner Berkovitz, questions?
Thank you, Mr. Chairman, and I thank the staff again. So I want to talk about something, clarify or just confirm the scope of the final release and what type of swaps the release permits. This deals with speculative or investment swaps. Let me quote from the preamble. The preamble states, quote, if a borrower enters into a swap with an IDI for speculative or investment purposes, the final rules would not allow the IDI to exclude such swap from its de minimis threshold calculation. So it seems clear from the preamble that a swap that itself is entered into for speculative or investment purposes, even otherwise meeting the conditions, would not qualify. Is that correct?
That's correct.
Thank you. I think that's an excellent clarification, and I think that makes the rule stronger. I very much support that. So let me turn now to the nature of the swap, to the nature of the customer. The provision permits IDIs to enter into loan-related swaps with customers. So let's say a hedge fund is engaged in speculative or investment activities with respect to energy futures. An IDI provides the hedge fund with a loan for those activities. The IDI then enters into a swap to hedge the risks incidental to the hedge fund's business. Would that swap be by the IDI be eligible for treatment under the IDI de minimis provision?
So, Commissioner, if I understand the hypothetical you presented, you have an insured depository institution entering into a loan with a customer that has met its risk or credit controls, it has met its safety and soundness obligations with bank regulatory oversight, and it has received probably some sort of collateral from the borrower in order to establish the loan. That's sort of the first step. The second step would be that the swap would need to be in connection with the loan. And so we look at things in the adopting release like the rate, the asset, the liability, other terms. We make sure that the swap term does not extend past the duration of the loan. We make sure in the adopting release the swap needs to be permitted under the right underwriting criteria. It needs to be commercially appropriate. All of those pieces are designed to provide flexibility to the IDI, again, subject to prudential oversight, to facilitate additional end user hedging. Again, and as you read the sentence from the adopting release, if it's a speculative or investment swap, that would not qualify for the exception.
Well, it's possible then, assuming the conditions that you laid out, that the IDI might have in terms of its operations, but it would be possible certainly that a hedge fund would be a customer under the rule.
Again, if it meets all of those criteria. And then the last thing I'd point out is in the regulation, there's a prohibition on sham loans that are entered into for the purpose of allowing speculative swaps activity.
Okay, thank you. So I take it could be with a hedge fund, assuming it meets various conditions. Let me ask about limits in the final rule. Subsection E in the current IDI exclusion limits the aggregate notional amount of all swaps entered into by a customer in connection with the financial terms of the loan, unquote, to be, quote, not more than the aggregate principal amount of the loan outstanding. So my question is, does the final rule before us today similarly cap the aggregate notional amount of swaps entered into by a customer with an IDI to the outstanding principal amount of the loan?
No, it does not. But as we've discussed, we're going to conduct a study to assess whether caps make sense.
Okay, thank you. Let me ask questions. I know there was you've talked about the data, and there's a table in the final rule indicating various estimates of notional activity by entities that may engage in these types of swaps. And I think Jeff, you talked about the data in that table 1 comes from SDR data for 2017. Is that correct?
That's correct. It's the same data we used for the June 2018 NPRM and the November 2018 adopting release when we set the de minimis threshold to $8 billion, Commissioner.
Okay, thank you. And so does the final release contain any data or estimate regarding the quantity of swap dealing that unregistered IDIs might undertake in the future as a result of the rule being adopted? Did you project how much might increase in order to that there might be as a result of the particular changes?
Commissioner, no, the proposal does not include such hypothesis.
Okay, thank you. And another topic is the entities that would potentially benefit. And again, you talked about the size of the notional amounts of unregistered dealers that there currently are who may be dealing in IDI excluded swaps. And the final release in several places talks about small and mid-sized IDI in a few places. The final rule says it would, quote, be beneficial primarily to small and mid-sized IDIs. Does the final rule limit it to small and mid-sized IDIs?
No, Commissioner, it doesn't. But when you correlate the dealing activity with the size of the banks, we found that there's a connection between lower AGNA levels and the size of the depository institution.
Thank you. That's all the questions I have.
Thank you. Are there any further questions before we go to statements? No. So we'll go to Commissioner statements. We'll begin with Commissioner Quintez.
Thank you, Mr. Chairman, and thank you again to the staff for your hard work and your continued work on this topic. I support today's final rule to amend the de minimis exception to swap dealer registration to include IDI loan-related factors. The amendments facilitate IDI's provision of hedging swaps to end-user borrowers trying to mitigate the myriad of risks that they face: interest rate risks, currency risks, commodity price risk, facing their businesses every day that relate to the connection of their loans. When Congress adopted the definition of a swap dealer in the Commodity Exchange Act, it recognized that small and medium-sized banks play a crucial role in providing credit and risk mitigation services to end-user borrowers. In my view, today's amendments further congressional intent, better align the Commission's swap dealer registration framework with the risk mitigation needs of bank customers, and more accurately reflect current market practices between IDIs and their borrowers. By amending the de minimis exception from swap dealer registration, the Commission is providing small and regional banks with greater flexibility to serve their customers' needs and greater regulatory clarity about the types of de minimis swap dealing activity they can engage in without triggering registration. I'm also pleased, as we heard this morning, that these amendments were completed with the full coordination of the Securities and Exchange Commission as well as other prudential regulators. These amendments are absolutely essential to helping rationalize the de minimis threshold and ensure that end users and Main Street businesses don't suffer from an overly prescriptive, punitive, and far-reaching regulatory regime that was initially meant to target the largest financial entities. The Commission's no-action letter recently to a Main Street bank this past August demonstrates the need to remedy the inadequacies of the current de minimis regime to ensure that legitimate client hedging activity is not artificially constrained. Since that time, the Commission has received similar requests for no-action relief from other banks in order to meet their customers' needs. These needs are especially acute in the light of a rising interest rate environment. Many businesses who have received credit over the last several years may not have felt the need to hedge their interest rates, given that rates were low and stable. However, in a rising rate environment, banks, IDIs, should have the flexibility to offer their customers hedging services on those prior extensions of credit without artificially falling into the swap dealer registration regime. I believe that today's final rule appropriately addresses these concerns. However, as I have said repeatedly and as I was saying this morning, today's amendments are but one of many improvements to the de minimis threshold contemplated by the June 2018 reproposal, which must be finalized. As I have said repeatedly, notional value is a poor measure of risk, a poor measure of activity, and a meaningless measure of risk. Identifying a de minimis quantity of a meaningless number still yields a meaningless number. Therefore, by itself, notional value is a deficient registration metric by which to impose large policy costs and achieve substantial policy objectives. But yet it is one that the CFTC has repeatedly and inexplicably embraced in this context. I'm encouraged that following the Chairman's specific and public direction in November of 2018, for which I am very grateful to him for his leadership. Staff continues to study both additional adjustments to notional value that would better account for differences between various products and alternative risk-based registration metrics that could better align the criteria of a de minimis threshold with the costs of swap dealer regulation, particularly the largest costs tied to mitigating systemic risk, such as capital margin requirements, and to a better sense as to the true size of the marketplace. The results of this staff report will be critical to the Commission's continued consideration of a more risk-sensitive swap dealer registration threshold. On that note, I'd like to commend DSIO staff for their hard work on finalizing these amendments and their ongoing tireless efforts to produce data analyses that the Commission can use to further inform necessary improvements to our swap dealer registration regime. Thank you again for your time. I look forward to supporting the rule. Thank you, Mr. Chairman.
Commissioner Benham.
Thanks, Mr. Chairman. There's no doubt in my mind that we have to make changes to the IDI rule. As I said before, we're now almost 7 years past, and we've learned from the market, we've learned from internal data that the original drafting was not done appropriately, and that's fine. You know, we're not going to get everything right on the first time. I think this has been a point of your leadership, and I think we've done quite a few very, very important rule changes to improve our rule set. Also listening to my fellow commissioners, there's no doubt in my mind that I think we agree on a lot of things. There's a lot in this proposal that I think is important, that's well done, that's based on data and facts, and based on communications with our stakeholders, and it keeps in line what the purpose of Dodd-Frank and Title VII were as well. But in my mind, as I've said before in my opening statement and through my line of questioning, I just don't think this is the way to do it. We need to adhere to congressional intent, and we need to adhere, in my mind, to what's pretty clear statutory language about how we go about amending the swap dealer definition. And despite your statements regarding coordination, which I appreciate, and again appreciate all the work of the staff with the SEC and with our prudential regulators, coordination does not supplant harmonization and ultimately joint rulemaking, which is, in my mind, the way this needed to be done. You know, I came here, I gave a prepared remarks a month or two after I was sworn in, and I made it a point to very clearly express my desire to work with the chairman and find common sense solutions to unintended consequences and rules that were not implemented appropriately, both because of mistake potentially, but also because a new regime of swaps regulation after the Dodd-Frank Act. And as much as I regret having to vote no today, and telling the stakeholders who care about these issues, I'm going to have to take the no vote, because we have to adhere to process. We have to adhere to the statute that binds us, and we can't take shortcuts because it's bad precedent and it becomes a slippery slope. We had a number of no action letter requests coming in after the proposal from June. And I think there was certainly alternate ways to approach this. We could have granted no action relief, conducted a study, and aimed to do this in an appropriate way with the SEC. So, despite all that, Mr. Chairman, thank you for your leadership. Thank you to all of you for the hard work you do. I appreciate your time. I appreciate you answering my questions. But I'll be taking a no vote today. Thank you.
Thank you, Commissioner. Commissioner Stump?
I'll be very brief. I just wanted to remind everyone that the only other open meeting I've participated in was the one in which we finalized the de minimis threshold. And I suggested at that time that all of my votes would be cast from a view of how well we were doing. And I gave us a grade of incomplete on de minimis, not because I didn't support finalizing the threshold, but I just felt there was more work to be done. Having worked within the confines of this statute for a very long time, it is quite confusing, it is complicated, and it provides this agency a fair bit of discretion. So I'm very pleased that you all have worked very hard and spent many hours with our colleagues, not only at the SEC, but the other regulators, to ensure that I can finally give us a complete grade on this particular provision. And I will be voting in favor of the provision.
Thank you. Commissioner Berkovitz.
Thank you, Mr. Chairman. I respectfully dissent from today's rulemaking amending the de minimis exception to the swap dealer definition. The rule before us today violates both substantive and procedural provisions of the Dodd-Frank Act. Voltaire famously commented, "This body, which calls itself the Holy Roman Empire, was in no way holy, nor Roman, nor an empire." Likewise, the final rule that is called, quote, the IDI de minimis provision in the final release is neither an IDI loan provision, nor is it a de minimis provision. The final rule is purportedly being adopted under the Dodd-Frank provision requiring that, quote, the Commission shall exempt from designation as a swap dealer an entity that engages in, and here are the key words, a de minimis quantity of swap dealing. A de minimis quantity of swap dealing. But the final rule allows an IDI to exclude an unlimited quantity of loan-related dealing swaps. Under no circumstances can an unlimited quantity of swaps be a de minimis quantity. The final rule allows IDIs to avoid swap dealer registration and regulation despite engaging in unlimited swap dealing. This can't possibly be what Congress intended with the de minimis clause. Turning to the rule's procedural failures, the final rule evades the directive from Congress that the term swap dealer be defined only through joint rulemaking with the Securities and Exchange Commission. In 2012, the CFTC and SEC jointly defined the term swap dealer. As directed by Congress, the two commissions created the quantitative de minimis exception in paragraph 4 of the definition. The Commission separately created the IDI swap dealing exclusion in paragraph 5. The IDI exclusion effectively prevents swap dealer registration from interfering with the core loan origination business of banks. The final rule rewrites this IDI exclusion, but stuffs the rewrite into the de minimis provision. In the proposed rule, the Commission virtually acknowledged that this drafting hocus pocus is being undertaken to circumvent the will of Congress that swap dealing be defined only through joint rulemakings with the SEC. To call an unlimited amount of swap dealing de minimis takes a lot of chutzpah, in my view. In November 2018, the Commission unanimously approved setting the de minimis quantity threshold at $8 billion. The $8 billion threshold applied to all types of dealing swaps. Now, less than 4 months later, the final rule removes this threshold limitation for IDIs entering into loan-related swaps. This is not what the Congress intended with an exemption from registration for, quote, a de minimis quantity of swap dealing. The preamble claims that the amount of swap dealing permitted by the final rule is de minimis because it is, quote, sufficiently modest in light of the total size, concentration, and other attributes of the applicable markets, unquote. This rationale is deficient. First, the Commission has presented no analysis of an estimated amount of excluded swap dealing under the final rule. The Commission has presented data only on the current amount of IDI loan-related activity that falls under the IDI swap dealing exclusion. In the absence of any estimate of the total amount of swap dealing excluded that will be excluded under the final rule, the Commission has no basis to conclude that this excluded amount is, quote, sufficiently modest. To address the problem, the preamble states that the Commission's Office of the Chief Economist will, within 3 years, study whether the swap should be capped to qualify for the de minimis provision. This approach is like opening the barn door today and 3 years later studying where the cows went. Second, this approach is inconsistent with the approach taken just 4 months ago in the de minimis threshold rulemaking. At that time, the Commission determined that registration was warranted if an entity engages in $8 billion or more of swap dealing activity. The new de minimis provision of this final rule will allow an entity to engage in more than $8 billion of swap dealing and not register. The quote, sufficiently modest rationale proffered in today's rulemaking, including the numerical computations that 8 billion compared to 221 trillion is small, that particular rationale was rejected in the prior de minimis rulemaking when suggested by commenters who advocated raising the level to 20, 50, or $100 billion. Let's now consider some of the unregulated dealing that the final rule allows. Paragraph C2.1 of the final rule includes swaps related to a financial term of a loan. The clause is essentially the same as the corresponding clause in the IDI swap dealing exclusion. But importantly, the IDI swap dealing exclusion limits all swaps executed in connection with the financial terms of a loan to a notional amount equal to 100% of the loan amount. Under the final rule, in what is supposed to be a de minimis provision, there was no cap on such swaps either for a single loan or all such loans in the aggregate. Under paragraph C2, Romanet I, an IDI could enter into an interest rate swap, a currency swap, and a swap that changes the duration of the loan, or any other type of swap related to the terms of the loan, and each one could be greater than the amount of the loan. Turning to paragraph C2, Romanet II, the final rule has made the required connection to the loan much more tenuous. It allows IDIs to enter into swaps that are permissible under the IDI's underwriting criteria, as opposed to required, which is the condition under the current provision, and commercially reasonable to hedge risks incidental to the borrower's business. As an example, an IDI can make a 10-year, $10 million loan to an airline and then 2 years later enter it into a jet fuel swap with a notional value of $5 billion. Or an IDI bank could enter into a loan with an oil company for the construction of a new office building and then enter into an unlimited amount of commodity swaps to hedge the oil company's entire portfolio of exploration, production, and sales. These swaps would not count toward the IDI's de minimis threshold. This cannot possibly be the de minimis quantity of swap dealing intended by Congress. The preamble claims that the amendment supports a clearer and more streamlined application of the de minimis exception and provide greater clarity which swaps need to be counted. The final rule does the opposite. The final rule replaces one IDI provision with two, an IDI swap dealing exclusion in which swaps are not considered dealing, and a new IDI de minimis provision which treats the swaps as dealing, but then says the swap that meets various criteria isn't counted towards the de minimis threshold. Is that more clear or streamlined? I don't think so. In another respect, the final rule may be a wolf in sheep's clothing. In the guise of helping small and mid-sized banks, it opens the door for larger banks to undertake an unlimited notional amount of swap dealing with loan customers without registering as swap dealers. The handful of larger banks that will most benefit, large regional or some national commercial banks, compete with smaller banks for loan business from Main Street companies. The larger institutions have the resources to develop expansive swap dealing capabilities. The smaller banks, typically operating in one state, do not have the resources to do so. The end result could be less competition in the local lending markets. This is not what Congress intended with the IDI exclusion. In addition to its various substantive infirmities, the Commission's vote today violates a mandate from Congress to define or amend the term swap dealer jointly with the SEC. Under Section 712 of the Dodd-Frank Act, defining or amending the term swap dealer must be accomplished through joint rulemaking by the CFTC with the SEC. And as discussed, in 2012, the CFTC and SEC jointly adopted the CFTC regulation further defining the term swap dealer. The agencies adopted the de minimis exception as paragraph 4, and separately, the IDI swap dealing exclusion is paragraph 5. Today, the Commission majority is making changes to the IDI swap dealing exclusion, which must be done jointly, and jamming them into the de minimis exception. This is an evasion of the joint rulemaking requirement mandated by Congress. A comparison of the final rule text with that of paragraph 5, which is the IDI swap dealing exclusion, as well as the Commission's own words describing this provision, confirms that it really is an amendment to the IDI swap dealing exclusion under another name. The preamble to the final rule declares that, quote, any swap that meets the requirements for the IDI swap dealing exclusion would also meet the requirements of the IDI de minimis provision, unquote. In the proposed rule, the Commission stated, quote, rather than proposing to revise the scope of activity that constitutes swap dealing, the Commission is proposing to amend paragraph 4 of the SD definition, which addresses the de minimis exception. The Commission then went on to say in the proposal, quote, the IDI de minimis provision would have requirements are similar to the IDI swap dealing exclusion, but would encompass a broader scope of loan-related swaps, unquote. Calling it a de minimis provision does not alter its essential nature as an exclusion for IDI loan-related swaps. An exclusion for IDI loan-related swaps must be done through joint rulemaking. Let me just add, experience has shown that some of the conditions, I believe, I agree, some of these conditions in the IDI swap dealing exclusion may be too restrictive. I am not opposed to reasonable incremental changes to the current IDI swap dealing exclusion if the changes serve the public policy goals and are adopted in the manner set forth by Congress. But this is not what the rule before us today does. Following the rule of law is critical to maintaining a robust, safe, and integrated financial regulatory system that inspires confidence for both market participants and the public at large. The United States' reputation as a rule of law nation is part of what makes our markets so attractive around the world. The rule of law applies no less to us as regulators than to the persons we regulate. The rule adopted by the Commission today is inconsistent with the requirements of the Commodity Exchange Act for the regulation of swap dealers and violates the Dodd-Frank Act as to the process for those amending those regulations. I therefore dissent. Thank you.
Thank you, Commissioner. We've had a good discussion this morning about legal authority, statutory interpretation, and joint rulemaking. They are not unimportant concerns, raised in good faith and seriousness and intelligence by my colleagues, and I thank them. We've also discussed how this proposal will spare small and mid-sized banks from certain derivatives requirements. That is true, and that indeed is important for America's regional banks. But I suggest to you that this proposal is far more important than all of those concerns. This proposal will enable small and medium-sized commercial borrowers, manufacturers, home builders, agricultural cooperatives, community hospitals, and small municipalities to conduct prudent business risk management, necessary risk management that has been constricted under the current rule. Let me explain. I recently telephoned senior executives of several regional banks to hear about their commercial lending and swaps hedging practices. One bank executive serving clients in the Mid-Atlantic explained that his bank was the only bank service provider to most of his small and medium-sized business clients. If his regional bank could not offer these smaller businesses a fixed interest rate swap to hedge their floating rate loan borrowing, then these borrowers had no means to hedge their exposure to rising interest rates on their loans. Another executive with a Southeastern bank explained that regulatory limitations on his bank's ability to offer swap hedging facilities to small and medium-sized borrowers meant that they remained exposed to rising interest rates, putting them at risk of having to curtail operations or lay off workers if rates rose. Here's the point. The current situation is pushing risk down into the real economy of jobs and livelihoods, rather than mitigating risk to the economy as derivative market reforms were intended in the first place. Another executive with a bank headquartered in Ohio said that greater regulatory flexibility would allow his bank to be there for its clients, not only in good times, but in bad times of greater interest rate volatility. It would allow his bank to provide properly hedged lending to support good jobs, healthy communities, and safe retirements in towns throughout the Midwest. I specifically asked each of these executives if they would engage in more swaps dealing to compete with Wall Street if this rule went through, and they all laughed. Each of them said they had no intention whatsoever to engage in that type of swaps dealing or speculate in swaps. They said that their prudential bank regulators would never allow them to do that. And they made it clear that their intention was to use swaps to mitigate the risk of floating rate commercial loans used to invest in their local communities, and nothing else. And these conversations made clear to me that today's proposed rulemaking is about much more than, as important as they are, of legal technicalities, congressional intent, joint rulemaking, or even relief for small and medium-sized banks. It's not about the banks. It's about the people that borrow money from them. It's about allowing America's small business borrowers and job creators to conduct prudent business risk management. It's about investment in local communities and the real economy. And it's about increasing prosperity and employing our fellow Americans. And for me, things just don't get more important than that. Thank you very much. Are commissioners prepared to vote? If so, Mr. Kirkpatrick, would you take the roll?
The motion now before the Commission is on the adoption of the final rule on the de minimis exception to the swap dealer definition for swaps entered into by insured depository institutions in connection with loans to customers. Commissioner Berkovitz.
No.
Commissioner Berkovitz votes no. Commissioner Stump.
Aye.
Commissioner Stump votes aye. Commissioner Benham.
No.
Commissioner Benham votes no. Commissioner Quintens.
Aye.
Commissioner Quintens votes aye. Chairman Giancarlo.
Aye.
Chairman Giancarlo votes aye. Mr. Chairman, on this matter, the ayes have 3, the noes have 2.
Thank you, Mr. Kirkpatrick. Thank you, staff from DSIO. Thank you, all participants in this meeting, either here in the room or on the phone. And thank you, my fellow commissioners, for bringing to all of these matters thoughtfulness, intelligence, clarity. And it's remarkable how we continue to work together, not always agreeing, but in a respectful and a decent tone, which I think our fellow Americans expect from us. So thank you very much. With that, the meeting will come to an end.